Hey everyone, welcome back to Canada Accounting Insights. Today we're tackling a topic that shows up all the time in both financial reporting and the CPA exams: related party transactions. If you've ever wondered what exactly makes a transaction related, how to measure it under ASPE versus IFRS, or why these rules even exist, stay tuned, because we're about to break it all down with clear logic, real examples, and practical journal entries. And before we dive in, don't forget to like, subscribe, and hit the bell icon so you don't miss our upcoming videos. All right, let's jump right in. Under ASPE 3840, Related Party Transactions, or RPTs, are exchanges between parties that aren't dealing at arm's length. That means one party can influence or control the other's decisions, directly or indirectly, and that power might affect how the transaction is priced or structured. Common examples include companies under common control, parent and subsidiary relationships, and transactions involving management, directors, or even their immediate families. Essentially, if one party can significantly sway the other's decisions, that's a related party relationship, because these transactions might not reflect market conditions. When one related company sells an asset below fair value, another party, like a minority shareholder, could lose out. So, ASPE adds specific measurement and disclosure rules to make sure users of the financial statements understand what's going on behind the scenes. Let's bring this to life with an example. Imagine Sunrise Manufacturing owns 60% of Horizon Tools, Inc., and Horizon owns 100% of Maple Distribution. Now, the owner of the other 40% of Horizon is Daniel Lee, who also has family members working in management. All of these, Sunrise, Horizon, Maple, Daniel Lee, and his immediate family, are related parties under ASPE 3840. If Horizon sells equipment to Maple, or if Daniel's family receives loans from the group, those are related party transactions that need special accounting treatment. Under ASPE, there are two main measurement bases for related party transactions. 1. Carrying amount, the book value recorded by the seller. 2. Exchange amount, the price the related parties agree on, which may or may not be fair value. Here's the key difference. If the transaction is measured at carrying amount, any difference between carrying values is booked directly to equity, usually contributed surplus or retained earnings. If it's measured at exchange amount, the difference goes through income as a gain or loss. Let's walk through a quick example to see both in action. Say Cafe Nova buys an oven from its related company, Bistro Luna, for $5,000. For Bistro Luna, the oven's carrying value is $5,500, original cost $7,000, accumulated depreciation $1,500. If the transaction must be recorded at carrying value, here's the journal entry of how it looks. Now, if it's recorded at the exchange amount of $5,000, the journal entry would be like this. See the difference? At the exchange amount, the loss hits the income statement. At the carrying amount, the difference goes straight to equity. Smooth, right? Now let's talk about how we decide which method to use. ASPE provides a decision tree to help determine when to measure at carrying versus exchange amount. Let's walk through each step. Step 1. Has a related party transaction occurred? This is straightforward. Check if the parties are related before the transaction. If the relationship only forms because of the transaction, then it's not a related party transaction. Step 2. Is it in the normal course of operations? A transaction is in the normal course if it's something the business does regularly to generate revenue. For example, a car dealership selling cars? Normal. A car dealership selling its office building? Not normal. If it's not in the normal course, we move to step 3. If it is, we skip to step 5. Step 3, is the change in ownership substantive? Usually, a substantive change means at least 20% of ownership has changed hands. If there's no substantive change, measure at carrying amount. If there is a substantive change, move to step 4. Step 4, is there independent evidence supporting the exchange amount? Independent evidence could include appraisals, market comparisons, or bids from unrelated parties. If the exchange price is supported by such evidence, we move to step 5. If not, measure at carrying amount. Let's make that more concrete with an example. Harbor Decor buys a delivery van from North Shore Rentals, a related company. The van's carrying value is $30,000, and similar vans on the market sell for $35,000. If the sale happens at $35,000, the price is supported by independent evidence, so we measure at the exchange amount. But if the sale happens at $25,000, it's not supported, so we stick with carrying amount and record the difference through equity. Step 5, is it a non-monetary transaction? If cash or other monetary items are exchanged, we measure at exchange amount. If the exchange involves only non-monetary items, like swapping assets or services, we move to the final two questions. Step 5.1. Is it an exchange of products held for sale to facilitate sales? This means the entities swap goods in their normal business just to make sales easier, like two retail stores exchanging inventory. These are measured at carrying amount. Step 5.2. Does the transaction have commercial substance? If the transaction changes future cash flows in a meaningful way, either in timing, configuration, or amount, it has commercial substance and is measured at exchange amount. If not, it stays at carrying amount. Let's say Party Pro Rentals exchanges event decor services with Tented Events Curricures, which provides tents. Party Pro's supplies have a book value of $300 and fair value of $500. The tent rental is worth $450. Since both companies are related and the exchange is non-monetary, we ask, does it have commercial substance? Yes, because each party gets a different type of asset and future cash flows will change. Therefore, both record the exchange at the exchange amount of $500. Now that we've covered measurement, let's talk about presentation and disclosure. ASPE 3840 requires disclosure of the relationship between the parties, the nature and amount of each transaction, the measurement basis used, any outstanding balances or contractual obligations, and any contingencies involving related parties. When in doubt, always ask, would this information be relevant to users of the financial statements? If yes, disclose it. Here's where it gets interesting. Under IFRS, specifically IAS 24, related party transactions are not measured differently. They're recorded just like any other transaction, at the exchange amount, unless another standard, like fair value or cost, applies. So the biggest difference between IFRS and ASPE is measurement. ASPE sometimes uses the carrying amount, while IFRS almost always uses the exchange amount. However, IFRS goes much deeper on disclosure. IAS 24 requires disclosure of the nature of the relationships, even if no transactions occurred, the name of the parent and ultimate controlling party, and key management compensation broken down into short-term benefits, post-employment benefits, other long-term benefits, termination benefits, and share-based payments. Now let's see an example of the differences between IFRS and ASPE. Let's say Aurora Textiles and Silverline Distribution are both 80% owned by the same individual. Aurora sells land to Silverline for $35,000. The land's book value is $28,000, and this transaction is not in the normal course of operations. Under IFRS, both record the transaction at the exchange amount, $35,000. Aurora recognizes a gain of $7,000, and Silverline records land at $35,000. Under ASPE, the same transaction would be measured at the carrying amount because the change in ownership is not substantive. The same person controls both companies before and after. So Aurora records it at book value, with the difference going to contributed surplus, not income. All right, let's wrap it up. Related party transactions happen when control or significant influence exists between parties. Under ASPE, measurement can be at carrying or exchange amount depending on the decision tree. Under IFRS, they're almost always at exchange amount with much more detailed disclosures. Always remember, transparency is key. Users must understand how relationships may impact the numbers. And that's a wrap on related party transactions, ASPE versus IFRS. If this breakdown helped you understand how to tackle these transactions in financial statements or in your next CPA exam, make sure to like this video, subscribe to Canada Accounting Insights, and drop a comment below telling me what topic you want to see next. Until next time, keep learning, keep practicing, and I'll see you in the next video.